All right, let's jump right in. Today, we're doing a technical deep dive into something that trips up a lot of people, the tax rules for property damage settlements. We're going to break down exactly how the IRS looks at that check you get from an insurance company and what you really need to do about it. So here's our game plan for today. We're going to start with the absolute foundation, the concept of a return of capital. Then we'll get into the core mechanic, which is all about basis. After that, we'll tackle what to do with gains and losses, which have totally different rules, especially after the Tax Cuts and Jobs Act. We'll look at the unique nuances for business property, and then finally, we'll put it all together and see how it gets reported on Form 4684.
First things first, we have to understand the why. Why does the IRS treat these payments the way they do? It's not just some random rule. It's actually built on some really fundamental legal ideas that have been around for a long time.
And it all starts with this core idea, diminished value. Now, this is so important. We're not talking about the cash it takes to fix a dent or replace a bumper. We're talking about the permanent drop in your car's resale value, just because it now has an accident on its record. It's that market stigma that a future buyer's going to see and use to lowball you. That's the loss you're being compensated for. So how does the tax system handle that? Well, it all hinges on a huge Supreme Court principle called the origin of the claim doctrine. The whole idea is to ask, what is this money really for? Is it to replace lost wages? Nope. Is it punitive damages? Nope. In our case, the claim originates from damage to your property, a capital asset. So the tax treatment follows the asset itself. It doesn't get treated like new income. And boom, here it is in black and white, straight from the IRS. This is Revenue Ruling 81-277, and it's the key piece of guidance. It makes it crystal clear. When you get money for damage to your property, it's considered a return of capital. You're basically just getting a piece of your original investment back. This isn't profit, it's making you whole. And that's the foundational rule for everything else we're about to talk about. Okay, so if a settlement is just you getting your own capital back, how in the world do we keep track of that capital? Well, the answer is a concept called basis. And let me tell you, basis is the central gear in the entire machine of property tax law. So, Internal Revenue Code Section 1012 tells us how to figure out our starting basis. It's actually pretty logical. You take the purchase price, you add in things like sales tax, shipping fees, even dealer prep fees, and don't forget any big improvements you make, like adding a tow package. You add all that up, and that total number, that's your capital investment, that's your basis.
Now, this is absolutely critical. IRC Section 1016 gives us a strict, step-by-step formula we have to follow. First, you figure out your adjusted basis, which might be lower if you've taken depreciation. Then, you subtract the settlement money you received. And here is the crucial third step. You look at the result. If that number is negative, that negative amount is a taxable gain. Why? Because you've gotten back more in cash than you had invested in the first place, and the IRS sees that extra bit as income.
And this is where the theory hits the road, and you can really see how this plays out. Look at case 1. You get an $8,000 settlement on a car with a $45,000 basis. Easy. The basis just goes down to $37,000. No tax. But now, check out case 3, the classic car. Your basis is only $20,000, but you get a huge $25,000 settlement. That means you have a $5,000 taxable gain. And look at the business vehicle. It's been depreciated way down to a $5,000 basis. So even an $8,000 settlement creates a $3,000 gain. It's the same kind of event, but with totally different tax results. Okay, so what happens if you're in that classic car situation? You've got a taxable gain from an accident. Are you just stuck paying the tax bill? Well, not necessarily. The tax code actually has a really powerful relief valve for these exact kinds of situations. This scenario, where an accident actually creates a gain, gets a fancy name in the tax code, an involuntary conversion under IRC Section 1033. Now, don't let the term intimidate you. It just means your property was turned into cash because of something you couldn't control. And yep, a car wreck fits perfectly under the official definition of destruction.
Now, Section 1033 lets you defer paying tax on that gain. I say defer, not eliminate. That's a key distinction. The catch is you have to reinvest that money into a similar property. But here's a pro tip that a lot of people miss. You don't necessarily have to buy a whole new car. The code is flexible enough that making major repairs or restoring the original damaged car can actually count as your reinvestment.
God, and this is a big but. You are on a clock. The timeline here is super strict. The replacement window closes 2 years after the end of the tax year in which you first realize that gain. So let's say you get the settlement check in February of 2025. That means your 2-year clock starts ticking at the end of 2025, giving you until the end of 2027 to get that replacement property.
All right, let's flip the coin and look at the opposite scenario. What if you have a loss that the insurance doesn't fully cover? Before 2018, you could often deduct that. But as you probably know, the Tax Cuts and Jobs Act, the TCJA, came along and completely rewrote the rules for this.
And here it is, the big change. Thanks to a new provision, IRC Section 165H5, the deduction for personal casualty losses is basically suspended all the way through 2025. The gate is just closed. The only way you can claim this kind of loss now is if it happens in a federally declared disaster zone. Your typical everyday car accident is just not going to qualify anymore.
But there is a fascinating little exception here, a lifeline really. It's a netting rule. And it says that if you have a casualty gain in one event, like our classic car example, you can use an otherwise non-deductible casualty loss from a totally different event in the same year to cancel out that gain. It's a really powerful way to make use of a loss that would otherwise be completely worthless on your tax return.
Okay, let's shift gears to business property. Now that TCJA suspension we just talked about, it doesn't apply here at all. But I gotta tell you, the rules are totally different and there is a massive tax trap waiting for you if you're not careful.
So on one hand, things are better. If your business truck has an uncompensated loss, it's generally fully deductible as an ordinary business loss under Section 1231. That's great, but the real danger isn't with losses, it's with gains. And it's because of a nasty little rule called depreciation recapture.
Think of Section 125 recapture like this. Over the years, the IRS gave you a nice tax benefit by letting you deduct depreciation. Now that you have a gain on that same asset, the IRS says, okay, time to pay the piper. They recapture that benefit by recharacterizing your gain. So instead of paying tax at the lower capital gains rates, you're going to pay at your much higher ordinary income tax rates.
And look how this plays out. It can be brutal. You've got a work vehicle that costs 50 grand, but you've depreciated it all the way down to a basis of just 5 grand. The vehicle gets totaled and insurance pays out $25,000. That creates a $20,000 gain. And because that entire $20,000 gain is less than the depreciation you took over the years, every single dollar of it gets taxed as ordinary income. Ouch.
Okay, we have covered a ton of theory, so let's get practical. How does all of this actually show up on your tax return? Well, the one-stop shop for all of this is a form called IRS Form 4684, Casualties and Thefts. And when you look at the form, you'll see it's literally split right down the middle. It's like 2 different worlds on one piece of paper. Section A is for your personal stuff, and it's subject to all those harsh limitations we talked about. Section B is for business property. It doesn't have those limits, and its results flow to a completely different form, Form 4797, because the tax code treats it all as part of your normal business operations. So to wrap all that up, here's your cheat sheet of the controlling authorities we've walked through. You've got Revenue Ruling 81277 that sets up the return of capital idea. You've got Section 1016 that forces you to reduce your basis. Section 1033 is your friend if you have a gain, letting you defer it. And then you have Section 165, which contains both that tough TCJA loss suspension and that very useful netting rule. This is basically the legal toolkit you need. And I want to leave you with this one critical thought. Even if your settlement is 100% tax-free, you are still required by law to reduce the basis of your property. It is not optional. Forgetting to do this might not seem like a big deal today, but it's a ticking time bomb. It guarantees that whenever you eventually sell that car, you will overstate your gain or understate your loss, and you could end up with a very nasty and very surprising tax bill years down the road.